Over the past year, the Federal Reserve has served as one of the major drivers for the stock market to hit record highs over and over again. This was done through policies such as low interest rates and quantitative easing. Most recently, Federal Reserve Chairman Jerome Powell released his projections for the future of the stock market, which has shaken the stock market substantially. In addition to this, the Fed also adjusted the capital requirements for US banks, which will set the stage for the future of the US economy. In this video, I will cover how the Federal Reserve shocked the entire stock market and where the Fed thinks the economy and market prices are heading in the future. Welcome to Kaz Gains Academy. If you're new to the channel, please consider subscribing for more content like this, and let's get right into it. First, to preface this video, the Federal Reserve definitely has a significant impact on the stock market. Therefore, it is important to consider the actions of the Federal Reserve and the impacts they have. In this graph, the blue line is the federal funds rate, and the red line is Nasdaq. Generally, the market goes up significantly when interest rates are low. In the past couple of decades, we've seen the largest bull market that was supported by the Federal Reserve's low interest rates. It's important to keep track of what the Federal Reserve does because oftentimes, it directly impacts the future of the stock market and the economy as a whole. Based on the government's actions, we can determine whether we should be bullish long-term on stocks, bonds, and maybe even cash in some cases. Over the past few months, the vaccine has begun to roll out worldwide, which has led many to believe that the economy is going to rebound quickly and smoothly. If the economy recovers, the Federal Reserve would no longer have to use financial policies like low interest rates in order to support consumers. With no more interest rates, we could ultimately see a stock market sell-off, as the main driver for the stock market was the Reserve's actions. Yet, while all eyes are on the economy recovering, the Federal Reserve Chairman Jerome Powell believes that the economy is still unstable in the services industry, but has recovered in many other areas. In other words, there are specific industries being hit the hardest. Overall consumer spending has increased recently, but there are important distinctions that must be made. Household spending on goods has increased lately, but household spending on services remains low, especially for the companies that are related to the travel industry. To go over what the economy is at large, housing prices have increased significantly, as the median listing price has gone up over 10% year over year. Additionally, business spending is also increasing by a substantial amount right now, as businesses are preparing for a full recovery. Lastly, the unemployment rate is slowly starting to decrease, although it still remains relatively high when compared to pre-pandemic levels. Jerome Powell, the Federal Reserve Chairman, admitted that this economic recovery was because of his monetary policies and the government's fiscal policies, which include the stimulus bill. This will be extremely important, as I'll mention later.
The economic recovery remains uneven and far from complete, and the path ahead remains uncertain. Following the moderation in the pace of the recovery that began toward the end of last year, indicators of economic activity and employment have turned up recently, although the sectors of the economy most adversely affected by the resurgence of the virus and by greater social distancing remain weak. Household spending on goods has risen notably so far this year. In contrast, household spending on services remains low, especially in services that typically require people to gather closely, including travel and hospitality. The housing sector has more than fully recovered from the downturn, while business investment and manufacturing production have also picked up. The overall recovery in economic activity since last spring is due importantly to unprecedented fiscal and monetary policy actions, which have provided essential support to households, businesses, and communities.
Essentially, Powell is saying that without the government support, the economy wouldn't be recovering this fast. All of this government support will lead to temporary inflation.
Over the next few months, 12-month measures of inflation will move up, as the very low readings from March and April of last year fall out of the calculation. Beyond these base effects, we could also see upward pressure on prices if spending rebounds quickly as the economy continues to reopen, particularly if supply bottlenecks limit how quickly production can respond in the near term. However, these one-time increases in prices are likely to have only transient effects on inflation. The median inflation projection of FOMC participants is 2.4% this year and declines to 2% next year before moving back up by the end of 2023.
This is where you might become skeptical. The Federal Reserve is projecting an inflation rate of 2.4%, which isn't much higher than the Federal Reserve's goal of achieving 2% inflation every year. Yet, the Fed's projected inflation rate was actually quite high, as their previous estimate for inflation was at 1.8% for 2021. Nevertheless, that increase honestly isn't much, and it's because the Federal Reserve believes they have found the secret sauce, and by that, I'm talking about inflation expectations. Powell believes that if the Federal Reserve expects and has a goal to keep inflation at 2%, then inflation will be anchored at 2% over the long run, as people will expect the Fed to create policies that keep the inflation rate at 2%. This will have a direct impact on the bond market and the actions we should do with the stock market.
You can only go out to dinner once per night, but a lot of people can go out to dinner, and they're not doing that now. They're not going to restaurants, not going to theaters. That part of the economy, and travel and hotels, that part of the economy is really not functioning at full capacity. But as that happens, people can start to spend. It's also wouldn't be surprising if, and you're seeing this now, particularly in the goods economy, there'll be bottlenecks. They won't be able to service all of the demand maybe for a period. So those things could lead to, and we've modeled that. Other people have too. And what we see is relatively modest increases in inflation. So, but those are not permanent things. You know, what'll happen is the supply side. The supply side in the United States is very dynamic. People start businesses. They reopen restaurants. You know, the airlines will be flying again. All of those things will happen. And so it'll turn out to be a one-time sort of bulge in prices, but it won't change inflation going forward because inflation expectations are strongly anchored around 2%. We know that inflation dynamics do evolve over time. There was a time when inflation went up, it would stay up, and that time is not now. That hasn't been the case for some decades. And we think we won't suddenly change to another regime. These things tend to change over time, and they tend to change when the central bank doesn't understand that having inflation expectations anchored at 2% is the key to it all. Having them anchored at 2% is what gives us the ability to push hard when the economy is really weak. If we saw inflation expectations moving materially above 2%, of course we would conduct policy in a way that would make sure that didn't happen. We're committed to having inflation expectations anchored at 2%, not materially above or below 2%.
Essentially, whether or not you personally believe that inflation will be at 2% does not matter, as the Federal Reserve will create policies to try to balance the rate at 2%. Given the information that we know, it's clear that we should be bullish on the stock market for long-term gains. This was seen in the latest move made by the Fed to choose to not support the bond market. On March 19th, the Federal Reserve decided to not extend the time on the supplementary leverage ratio. The supplementary leverage ratio is the ratio of capital that banks must have relative to their assets. During the pandemic, the Federal Reserve allowed banks to subtract their bond and cash holdings from their assets, which made it so that banks could loan out more money with less capital. Most recently, the Fed announced that this temporary rule would expire on March 31st, which clearly shows the Fed won't support bond prices. When bond prices go down, then bond yields go up. Because of this, we could see a further correction in tech stocks, but at the same time, bonds are not worth investing at the moment, as the 10-year treasury yield is lower than the inflation rate. Therefore, we should go long on stocks rather than bonds for long-term gains. Let me know what you think about the Federal Reserve's policies. If you enjoyed this video, please hit the like button and don't forget to subscribe, and I'll see you in the next one.